Hey guys, do you know what the word contrarian means or what it means to be a contrarian investor? I got the meaning up here and it says contrarian investing is an investment style in which investors purposefully go against prevailing market trends by selling when others are buying and buying when most investors are selling. So that kind of goes with Warren Buffett, who is probably the most famous, where he says, buy when there's blood in the streets, um, be greedy when others are fearful, and fearful when others are greedy. So, can you have the stomach to be a contrarian investor in single stocks? You know, if you're an index investor, it's a lot more easy, I guess, because the whole market's going down, right? You're not focusing in on one stock or two stocks. So I'm going to share with you three stocks today that I'm not saying they could be contrarian investments. Now, what's typical of most contrarian investments stocks are that they have been beaten down. They might possibly be poorly managed. They could be on the verge of a dividend cut. They may have already cut the dividend. In other words, it's not easy being a contrarian because a lot of times you're going to be investing into bad news, like very bad news a lot of times. But if you do it right, you could possibly turn this into something big. That is, if you play the long game. You cannot be a short-sighted contrarian investor. There's no way. I mean, you have to look at 5-10 years down and be able to possibly hold them that long while they keep going down. As long as the business is making effort to improve and you start to see, you start to believe in what they're doing, then you can, be a successful contrarian. But it's not easy to do. And these three stocks I'm going to share with you are excellent examples of that. So the first one's going to be Six Flags. Now I'll just go over some of the details real quick, because right now they have a forward PE of 16. They have a dividend yield of 8.7%, which they've grown that dividend 11.26% over the past 5 years. They've had 9 years of dividend growth. And I put on here recession proof. Now, the reason why I say recession proof, they may be under a lot of pressure right now, but they own a ton of amusement parks. And I think they've been a little mismanaged. Could this be a good thing when a recession hits? Because they are the low price leader when it comes to amusement parks. And in a recession, that can be a good thing, because with the people that can't afford to go spend $2,000 for a little Disney vacation, they might be able to sneak up $500-600 for a Six Flags vacation. You see what I'm saying? Now, Six Flags has done a lot to try to spur growth. They've had annual passes and memberships and things of that nature, dining passes. I like Six Flags. I like Six Flags parks. Whoops, let me lock this real quick. Sorry about that. I like their parks because they're not so busy. I'm not a big Disney fan because they're too dang busy. But Here's the problem right now with Six Flags. They have growth issues. Okay. So in 2019, they tried to, they put in a bid to buy Cedar Fair, who is the other amusement park owner in America, and they got rejected. And in my mind, it was kind of a desperation move because trying to spur growth is tough. You know, you either have to take it from other people by buying other companies, or you have to grow it organically. And they've kind of not been able to grow it organically as much. And in 2019, what really got them up to this 8.7% yield is that China decided to stop their investment in Six Flags and building parks over there. So that's two strikes against Six Flags in the growth department. You know, they could not. Their acquisition of Cedar Fair, you know, went downhill, and China went downhill. So where's their growth catalyst now? And that's the big issue with Six Flags right now. They do make they do make a lot of cash. I don't know. Their dividend is probably on the verge of being cut. Who knows? Maybe something happens in this next quarter here where they can come up with some way to spur some sort of growth. But if you're a contrarian, this hasn't been this high before. 8.7% dividend yield for a large amusement park with some growth issues. So all these stocks are going to have issues. Next one up, AMC Theaters. Their forward PE is negative. They have a dividend yield of 11%, growth of 0%. They did pay out. I've been researching AMC for quite a while, and I don't recall why they paid this out, but in 2018 they paid a special dividend of $1.55, which made 0 sense to me. With as much debt as they have, why would they spend this $1.55 into a dividend? It doesn't make sense. Because right now they're looking at a negative 19-cent earning per share with a dividend payout of 80 cents. So they're paying way more than they're earning. But a lot of this earning per share can be manipulated. So AMC is a little tough to value because there's a lot of depreciation costs that get, you know, bumped into that earning per share. So their cash flow is actually very good. But right now they're experiencing high expenses. And the streaming thing, I don't know. That's why I put on here recession proof as well. This is movies are a cheap way for families to go out and have fun. You know, it's not a NFL or NBA game where they're spending hundreds and hundreds of dollars to go have fun. You know, you can go watch a movie, and yeah, they're expensive. They're a little bit more expensive, you know, than they have been in the past. But you know, a couple can go out, you know, for $30, have a popcorn, a soda, and watch a movie. So it's not that crazy. The popcorn is expensive though. And that's some good popcorn. But they are transforming. They're spending a lot of money transforming some of these theaters into serving food, into serving beer, having nice recliners to sit in. You know, so do you think over the next 5 years that AMC can turn around and become a viable company? I believe so. I really do. Their expenses are high though. Labor expenses are high. Minimum wage is going up all over the place. So, you know, blood in the streets right now with AMC. Is it worth it? I don't know. And last on my list, Macerich. You know I had to throw a REIT in there, right? So Macerich, ticker symbol MAC. Is it Macerich or Macerich? I don't know. But its ticker symbol MAC has a price to funds from operation forward of 7.27. That's cheap for a REIT, but this is a mall REIT. Has a dividend yield right now of 11.65%. Excuse me. Growth of 4.65% over the 5-year. I would not expect that to grow anymore. They do have 8 years of dividend growth. They do cover this dividend. It's going to be real tight in 2020 though. But for 2019, they covered it pretty well. I think about 85%. But in 2020, that dividend's looking a little tight. Now, their problem, of course, with a mall is retailer bankruptcies. I have a Macerich Mall, which is right in my town, just a couple miles from me. And they have, on either end of that mall, is a JCPenney and a Forever 21. Both of those are probably going to go away. Forever 21's already declared bankruptcy. JCPenney, probably close to it. I mean, they are a penny stock right now, so they're struggling big time. So that's why I put on here execution. Now, this is what these companies do. So, when you say, a lot of these REITs, oh, this company's moving out or this company's gone bankrupt, what are they going to do? Well, that's what these guys do, is they fill up boxes, their retail boxes, and when someone moves out, they find someone else to move in. So now, is it going to be difficult? Yeah, it might be, but this is what they specialize in, is what I'm saying. So can they execute on filling these empty boxes? Because those are huge. That's a Forever 21 and a JCPenney is big square footage. Now, can they make them into a couple smaller stores? Can they expand it somehow? Make it some sort of mixed use or offices? I don't know. But this is what they specialize in. And they have a very high quality portfolio in Macerich. So I think they could. Could they get one of the ones that are very famous into filling up empty boxes is Planet Fitness. Can they get a Planet Fitness in one of those? It'd be kind of big, but just thinking outside of the box. Can they turn some of it into housing or whatever? Whatever. That's what these guys do. Now, if you got to look at the way Macerich executes their plan going forward, how they handle the empty boxes and the retailers going out of business, I don't think malls are going anywhere. So who would you pick out of these three? Since they all have blood in the streets, what would you do? They all pay very well dividends. My bet, I'm not taking any position in any of them, but if I were, I would probably do AMC theaters. Only because I know people love going to movies. And if they can continue to execute on their revamping of their theaters, and these people start making some good movies, I think AMC is going to be the winner of this in the next 10 years. So that's my call. I'm not saying invest in them, but if you have any thoughts on any of these three, put them down below. I know this went on a little longer than I thought. I kind of I'm talking and I'm kind of going off the top of my head. of what I think about these. I have no notes, so if you leave me a comment down below or a question, I'd love to answer them. Thank you for watching, and we'll talk to you later. Thanks. Bye-bye.